What's up, Outliers? You guys should be able to hear me. Let me know if there's any issues. As you probably can tell, your boy is on the mobile setup, so stuff isn't exactly how I typically roll. But okay, cool. Great. Thank you, Reggie. Oh, wow. That's actually pretty quick, too. I'm surprised. I did turn down the uh, the kilobytes per second that I'm sending through just to try and keep the frame rate up. So if there's any issues that pop up, let me know. But right now we are a few hours north of Anchorage. We are quite literally in the middle of nowhere. Like the nearest anything to us is about an hour away. So we're right outside of Denali. We've been having a super cool time, super thankful. This whole thing always reminds me of the cool part about having capital because you get to do fun things. So, the purpose of the stream today is really just to catch up with you guys, to see if anything is top of mind. There was a couple questions that I got in the Discord that I want to talk about. We'll take a quick look at the market. I'm not going to spend a ton of time going through like the market outlook and whatnot, just because, again, like I'm traveling and my trading activity, especially for this year, has slowed down tremendously. However, if there's any trades that you have on that you want to talk about, if there's any underlyings that you want to take a look at, we can talk about that. So this is really designed to be a little bit more of exactly what the title sounds like, a little bit more of a hangout, just conversational, talking about whatever is top of mind for you guys. And it's awesome to see everybody. So as usual, I'm seeing Reese, I see Kirk, I see Reggie, I see Zaddy, Lauren, ZX. Absolutely great to see everybody. Reese says shit's crazy boring, no vol, no volume. Yeah, and again, we've talked about this a little bit, but this is just absolute standard fare coming into the end of the year. Pretty much most people that are trading are doing exactly what I'm doing, right? And it's spending time doing whatever, visiting family, traveling a little bit. So there really is a pretty massive downturn in overall trading activity. Of note, though, vol is caught my eye a couple times. I was actually reading a couple papers about volatility, but this we have now reached absolute compression of vol. So before I'd spoken with my community a little bit, and we do like a market prep on Sundays just to get in the habit of looking at markets. And one of the things a week ago people were talking about was the fact that they felt that vol was compressed. And one of the things that I pointed out is I actually didn't at that point, depending on what time frame you look at, I actually viewed it that we were a little bit more in a transitory period. And you can see that because again, about a week ago, we're sitting, at like the 15 handle, we finished the transitory phase, and now we're clustering in like the mid 13s. If we look for longer term context, this is freaking low. This is really low. We're below the one standard deviation channel, as you might expect. And if we zoom out a little bit further, as always, get a little bit more context, this is the part that's kind of interesting. Is on a longer term time frame, we're not quite as skewed as I think people sometimes might think we are, just because of the recent volatility that we experienced. Right? We can see from earlier this year when we had that pretty profound. The stock market ran into a bear market during this period, so this was a decent move. And then over here from last year, vol is still overall declining, but believe it or not, as low as vol is right now, I absolutely believe we can go even lower still. Like, I do not believe that we are at the actual lows yet, which is kind of wild to say because of how low things are. I did catch a couple news bites today about Trump saying, that he had a good conversation with Zelensky, which that overall is good to see a little bit of progression there. I'm not exactly sure how far we've come, but I do want to spend a little time looking at that. right now, in case you were wondering, we're in like this super cool cabin. It's like a 3-story cabin. It used to be some park thing, and there's like this really fun elevator. But I am looking at the weather, and right now it's about 0 degrees Fahrenheit and super windy. So I haven't even really been able to fly the drone, but I'm looking outside at the trees because I definitely do want to put the drone up. All right, let's take a quick look at what's coming up for the week just from an economic lens, and then I will get into some of the questions that I got in the Discord and whatnot for a conversation. So for this week, what is this? No, I don't want your notifications. For this week, it will be pretty quiet. Now, the meeting minutes are coming out on Tuesday. I don't think there's any sort of big potential move here. And as always, we can fact check ourselves. We could take a look at what volatility is saying, which we will do. But I'm not expecting, any sort of huge catalyst. This week is really quiet, right? You can see on Wednesday there's a couple small things: jobless claims, mortgage rates. Mortgage rates not really going to impact much, and jobless claims have been quite static. So I think across the board, when we look at where we sit in the market right now, it really does seem like pretty quiet. I don't see a lot of high volatility items on the horizon, which is exactly why this time of year is literally perfect for conducting your annual after action reviews because it is so quiet, because there really isn't a whole lot going on. Now let's take a quick look at SPX. I just want to take a look at the vol surface and see specifically term structure, if there's any sort of expectation, and not really, right? If we take a look at, we're at 10% for tomorrow, 10.13, 11% for the 31st, and then back down to 10%. So, I mean, this is notably higher than the others by about 10%, but it's so low already that I really wouldn't read a whole lot much into this. NASCAR says if you look at the log scale of Dow over the last 100 years, we are, hold on, are there any similarities, 1982 to 2000, to what we are in now? Let's take a look. I think the problem with those really long-term time frames is it really is so difficult, in my opinion, to draw like any sort of strong conclusions, specifically because there's so much structural change that I struggle with that argument of like these broader, super long-term patterns. So here's what I mean. If we look at the world, what the world was doing 100 years ago, and then if we look at what the world is doing now, and we chart the difference over those two time frames, I struggle to say like 100 years ago, or even what was happening 50 years ago, is even like partially relevant to what we're seeing now. That's again a pure opinion. I've done a lot of statistical analysis on comparing different timeframes, rolling timeframes, overlapping timeframes, and there are absolutely anomalies that will pop up. But I'm not positive that it's super predictive. But nonetheless, absolutely happy to take a look at a sheer curiosity. So let's take a look. I think TradingView actually might be easier than using Thinkorswim for this. So let me see if I can log in super quick, and then we could take a peek there. I just think their charting, especially for like super long-term time frames like this, will probably be a little bit easier. And then we need the, do we want to use futures? Are you looking at futures, or are you looking at the index itself? What are you using to take a peek at? Because I don't even know, futures could be kind of interesting. Normally for stuff like this, I would use the index outright. Okay, so you're looking at DJI. Alrighty. Oh, what's all this shit? Okay, let me pull this over. Just want full screen, dude. Yep. And we're going out. Oh shit. We're going out a fucking eternity. So we'll just click to all. And then you said you're looking at monthly time frame, which is here. And then I don't know how to turn this one into log scale. Do you guys? I haven't fucked with that here. If I can't figure it out quick, I'll look. Let me just look it up real fast. That'll be a little faster. How do I make a trading view chart log scale? Right click and then logarithmic. There we go. Cool. That's easy enough. Okay. So NASCAR, talk to me about what you're seeing here. You're saying about 100 years ago. So that puts us kind of in here. And I honestly am not really seeing it. Because yeah, I don't really see it. BRB says talking 100-year cycles. Yeah, I think that's what NASCAR is talking about. He was saying that he was kind of noticing some interesting relationship between like Dow from the 20s to where we are now, but I'm not personally seeing it. Even with the overall volatility and whatnot, the overall volatility looks very different to me, which is again exactly what I would expect to see. I think just to reiterate that broader point, one of the most important things to pay attention to is like history has a lot of commonalities, but technology really is a massive disruptor, even in terms of the size of the moves that we see on average, which is really interesting. So, for example, one of the things I've noticed is that in the near term, meaning, the last 5 to 10 years, intraday volatility has gone up quite a lot, like measurably so. But overall market volatility on longer term timeframes, especially when you start going back a century plus, is actually contracted quite a lot. NASCAR says look around June 95. Oh, hold on. Did you say 100 years ago? Am I fucked up? Oh, you're saying over the past 100 years. Sorry. I misunderstood you. I'm sorry. So then look around June 95. Okay. I see what you're saying. Sorry. I was looking. Let's zoom in a little bit then. Let's go in here to like 1990. So what do we see in 95? Yeah, I mean, I guess you could say that this doesn't look that dissimilar from this, but I also honestly think you could find probably hundreds of points on this chart that we could say the same thing for. Like, this doesn't look that dissimilar. Yeah, so I guess I'm not too sure. I also, again, to be completely transparent, I don't spend a lot of time doing like super long term analysis like this exactly for what I was just talking about is like the catalysts, market structure. I mean, even if we took a look in terms of regulatory changes from the late 90s to now, there's quite a lot. So yeah, who knows? I definitely don't. I don't see anything in here personally that's like super striking. The other thing that I will also mention, because I always take the opportunity to do so, is I hate the Dow. I think the Dow is so stupid. The Dow is using the underlying price to figure out the weighting versus like market cap or something more logical. I really hate the Dow. I think it's so stupid. But anyways, I do appreciate you bringing it up. I'm always happy to take a look at stuff like this. It is always fun to poke through and see different periods in time. And again, I do agree. Like I can see like this doesn't look all that dissimilar to this, but I think from a scholastic perspective, the important thing is not to try and find periods that match what's going on now, but then to look in mass and see how frequently throughout this time frame that other periods match what we see now. And if we do that, my guess is it would be pretty strong. Like I think there's probably a ton of periods that will look similar to this very just grindy up movement. So, yeah. Okay. So I want to talk about, I think there was two questions that I saw in the Discord, and I will take a quick look. I'm going to close a couple things down just because it looks like this thing's, oh, there we go. Okay. So one question is from Puneet, and I released a video today for those that haven't seen. It is really about trading options in low volatility environments. That's the whole point of the video today. And Puneet says, I could use help with some bar chart scanning, finding opportunities. I am into some late stage continuation profit mechanisms with long calls on gold, silver, platinum, which definitely I would consider that late stage for sure. Unsure how much further these might go other than the TQs cover strangles. Yeah. So I don't really have like some sort of strong opinion on like bar chart scanning per se for this kind of stuff. But I think if you watch the video, you'll inherently come up with some ideas. So I'll grab the video really quick and then we'll poke through some spots in it for us. One sec. Let me open this bad Larry up. Okie doke. And there we go. Okay. So the video here, what we're doing is looking at different methodologies to trading volatility when it is low. So in here, I go through a couple different ways to think about it. So for Puneet, the way that you build scanners for this is just by kind of reasoning through ways to find stuff that look interesting to you for these. So for example, earnings plays, right? That's a super easy one. We just open up an earnings calendar and we see what's coming up. And that one's easy enough, right? We have effectively three or four profit mechanisms that we can tie directly to earnings. We have vol expansion into the release, vol contraction post release, gaps on day of release, post earnings announcement drift. So there's really four different things that you can trade around earnings plays. So that's an example of one. Relative volatility, you would have to come up with some sort of scanning protocol for looking within an options chain. So you would want to find ways to search for steepness. Catalysts, that one's a little trickier because sometimes a lot of the catalysts will be known, but then a lot of times they won't be known, which means that it'll be something that is like a corporate announcement where there's not some sort of like schedule coming out for it. But there's two ways to think of this. A great example is the MSOS trade. So there was a trade that I had in MSOS where I was looking just for elevated vol. And the way that I found that vol was by running some basic, vol scans, looking at implied versus realized and stuff like that. And then I find things like this that had quite a bit of vol priced in. So then the smart thing to do from there is to, ask ourselves some questions like, hey, why is this vol here? What do we think that this vol might be? Like that kind of stuff. I didn't really bother with it because it was just a pure vol play. But if I cared about that kind of stuff, what I would do is I would look up the names, right? And I would say, well, what's the deal here? And for MSOS, there was a pretty significant catalyst on the horizon with an expectation of a federal court ruling coming out weighing in on the classification of cannabis. And then what ended up actually coming out that shocked the market even more was Trump came out and made a statement. So you can find stuff like that by one of two ways, either paying attention to individual industries, looking up for upcoming, cases, upcoming statements related to policy preferences, stuff like that. The other thing that you can do is look for things that are moving a lot and figure out why. So a good way to do that is really simple. Where did my other window go? One sec. Let me find this window. What we can do is use literally anything that gives you a easy place to find stuff that's moving. Hold on, I think I gotta sign into this. Give me one sec. Yeah, I do. Okay. And hold on one sec. I just have to add a couple things to this. Okie doke. So let's take a quick look here. And if we look at things that have moved a lot, so FJet, I'm going to move this off to the side just so that I can go through a little quicker. If I type in FJet, my expectation is that there will be something that went on. Don't know exactly what, but we'll see. And it's not going to be actually difficult to see whatsoever. Things that have these big, massive moves, generally speaking, are going to occur. Wait a minute. Anti Robinhood? Hold on, hold on. Fuck yeah. What is this? Is this Robinhood the company? I hate Robinhood. Oh, damn, this is different. Ah, man, that got me so excited for no reason. I thought Trump, for whatever reason, was going to say that he didn't like Robinhood the company, and I was going to say, fucking here, here, big dog. But it's not. It's completely different. What a tease. Anyways, let's see what's going on with this thing. Clearly, something happens kind of all over the place, really, if you think about it. Let me scroll down here and let's see what's up. Uh, 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 uh. Recent IPO. So just general post IPO. So it's a good, like, this is a great example. This is literally a perfect example, right? So this thing just came IPO'd, and then we're seeing volatility being absolutely insane. So this gives you an idea right out of the gate that, hey, there's a ton of interest in this. It's all over the place. People clearly don't know how to price this thing yet. So I'm not sure if it has options yet. It does. So, I mean, there's your first place to start looking, right? So that's the thing that I want to connect you to there is the way that I find this as a catalyst is by looking through and finding stuff that's moving. So for Puneet, to summarize some of those points, you really just got to sit down and think a little bit, right? About those four things that I outline in the video. And then the next step is to sit down and ask yourself, how might this manifest and where might I see it? And that's literally it. You'll come across a bunch of ideas. Now, again, remember, a big part of trading is spending time looking at stuff. Not everything, conversely, the majority of stuff that you're going to look at isn't necessarily going to be something that's super useful. And I feel like sometimes, especially retail traders that do a lot of research, I think sometimes you can forget that. Meaning, retail traders, especially those in our community, they want to be as efficient as humanly possible, which is smart. But there is still a certain amount of like healthy research that isn't going to pan out. And again, the majority of the research you're going to do is going to be like that. So the reason why that ties to this conversation is you got to just sit down and jot ideas out and say, how do I think this thing might manifest? And just jot them out and then figure out how you can look for them. So if you have any specific examples of an idea that you have, happy to talk about that and see how we can, think through it together. But the most important part there is just doing that exercise of sit down and based on those four ideas that I gave you even to start, because the other thing to remember is like those four ideas, that's not all of them. That's literally just a handful to begin with. There's way more than that. So once you figure out what you think it might materialize as, then you figure out how you might see it, then you start building a scanner. If the research question starts from the place of, oh, I think these are some nifty ways to find low vol, how do I build a scanner? Right? Like we haven't shrunk down the problem set enough into something consumable and navigable. Okay, next one that I saw in here. I think this one is from Mindlich. So Mindlich had asked me, among your strategies, how many and how much percentage of capital or risk are exploiting market inefficiencies and how much are farming well-known risk premia? And effectively, I responded to that is I don't really bucket things like that. So I couldn't say for how I trade, it's really a sliding scale based on what the market is doing. And then they had a follow up. If you don't bucket things in this manner, why is that? I feel like it's a lot of quantitative trading obsesses over this distinction. And from what I'm seeing, there's quite a bit of difference between both. So for Minlich, the reason for this is because I really spend most of my time trying to look at what the market is doing and then looking for opportunities within the market. So, what that means is I don't open up my platform and say, how do I find risk premia? How do I find inefficiencies? That's not the way that I approach the problem set at all. I start the question from what's the market doing? What does my portfolio have is existing positions? And where do I see opportunity? Sometimes that opportunity might lean more heavily into risk premia, sometimes in inefficiencies. Sometimes it might be really neither of those. Those aren't the only two market factors that exist. I guess technically they could be depending on how serious you take the term inefficiencies, but then risk premia would fall under inefficiencies if we're being that literal. So, anyways, the main point to that, and Minlich, I don't know if you're on the stream, but for you, the reason why I don't bucket it that way is because that's not the way that I look at the market. I have strategies that allow me to take advantage of pretty much any market condition. So then my job is to look at my portfolio and figure out what kind of risk I may want, and then either scanning for that specific risk, or if I don't have a specific risk, but I just want to use more capital, then I'm scanning for whatever looks the most appetizing to me. So I don't really care how much of the portfolio is doing one or the other. And it's also because I don't break down my strategies that way. I break them down, as I've discussed before, into like core and speculative. And then within that, each strategy typically attacks a profit mechanism and a sub profit mechanism. So I'm looking in there normally. So that's a good question. Okay. And then I think somebody from the chat had mentioned that they wanted to look at a stock. Where is it? Where is it? ISRG. Yeah, let's take a look at ISRG. So it looks like they're saying for an earnings play. ISRG. Okay. So for ISRG, they don't have earnings for a bit. Their earnings isn't until the 22nd. So realistically speaking, I would have absolutely no opinion on it. We would need to wait some time in order for me to even come up with any sort of opinion. It's just way too far out. Now, that being said, what we can do is take a quick look at prior releases and just see if anything looks interesting from that lens. But yeah, with stuff like this, it to me at least, it's not even really worth doing some sort of deep earnings analysis. Um, I would have to also plug this in to see what I think of it, but I don't hate it. Yeah, I don't hate it. It's just so early, so I can't really weigh in otherwise. But I don't hate it at first glance. I wouldn't call that thing like some sort of immediate no or anything like that. It definitely requires a little more digging, I think, but it doesn't jump out at me as like terrible. NASCAR says DJIA is such a historical index tracking the stock market starting in 1896. It's just the OG index. Yeah, it definitely is. And the cool part about the Dow is for a long time it did really what it needed to do. But yeah, the issue obviously with like using price is just so arbitrary. It doesn't really even mean anything. So that part, I really don't understand why they don't just switch it to be something more logical. I actually like the fact that it's a little bit smaller. I like that the Dow has what, like 30 names or something like that in it. It's way smaller than S&P and Nasdaq, which that part I think is actually very cool. But Yeah, other than that, I think pretty much that's the only spot where any cool stuff exists about the DAO. I I don't hate the DAO as much as Robinhood, but I do hate the DAO. I think it's stupid. All right. What else you guys want to take a look at? What's interesting to you guys? I'm going to poke through the news while we talk and see what looks interesting. But if there's any stocks you want to take a look at, anything like that, I need to take a look at some of my positions, but I will do that and then just probably post an update for the pro members. But right now, there really just isn't that much going on. The portfolio is generally in a holding pattern. Right now, all I'm doing is seeing what the market has generally been doing in terms of premium and S&P index more broadly. And I mean, I'm not really seeing much. There's been some absolutely insane activity in SLV. And SLV has been going haywire. Uh, what the fuck was that? The whole house just shook. I have no idea why. SLV, I mean, take a look at this. Take a look at this move. This has been just an absolutely absurd move in SLV. And I think the metals themselves, the most interesting thing about this is that there's a fucking ceiling, man. Like there is a limit of what people will pay for this shit. So the way that I look at this is I miss this entire up move. I have very little going on in here. But what I look for is actually a reversal. Whenever this thing does eventually decide to snap back down to earth, that's when I get really interested. But when something is rolling this chaotically and just this strong, I just sit and watch, especially like I said, because I just, oh shit. I legit do not have much risk in here. So yeah, we'll, why does this thing keep going off? What am I fucking up? Close price is at or below. It's not below that. I have no idea why this thing's being so lame. Look at that, 9% on the day. Absolutely, absolutely insane. Let's see if this works. So it's got to be something buggy with that. We'll just do mark. Huh, strange. Let's take a look at the vol. Oh my god, look at that. 142%. That is absolute madness. I cannot believe that freaking metals are doing that. I'm logging into Moon Tower because my buddy Chris has a really, really, really cool way to view this stuff. And I want to take a look at this in there. So let me grab SLV. And we'll take a look at this thing. All right. Jesus Christ. I mean, this is absolutely insane. Look at this. Like the vol pretty much across the entire freaking structure is haywire. The 90-day looks interesting to me because the 90-day just hit max. And then we can see departure happening here in the 180-day vol. That's actually very, very interesting. But take a look at the term structure. This is quoting 86 for 7-day and 84. Let's see real quick how that lines up here. So for 7-day, again, it's an interpolation. So looks like it might be a little high, but that's going to use the at the monies versus most of the chain, like the other tool. So I think, I mean, that makes sense. And let's take a look at, oh my God, look at that. It's insane. So not only is the risk premium insanely high, but the realized moves are still continuing to cluster at these highs. I probably wouldn't want to trade a lot of vol and silver. For those that don't know, I already traded it once and I got ran over. I'm just going to close this window a little bit. I traded it once and I got I got absolutely ran over. I mean, not I'm being dramatic because it's kind of funny, but I managed it pretty quick just because of how fast silver was moving. But there will absolutely be an opportunity in here. I am more in the camp of waiting until it starts to reverse a little bit because it will happen. Even if it's not a ton, like if you take a look at this move here from here to here, that's still 16% over 2 trading weeks. That is decent money, especially on something like this where you have to think like at some point people are just going to say silver is literally just not worth that much fucking money. And there's compression and stuff going on right now. There's supply disruptions. So there's a lot of artificial things that are happening here. And this is actually a great example of catalyst style trading. Because if you pay attention to, for example, precious metals, and you wait until you see some sort of news about production coming, back online or coming online faster, because a big thing is production is ramping, but it's just like several years out. It doesn't ramp that fast. Like those are the kind of catalysts that can cause movement really, really quick. The way to think about something like SLV is right now, this thing is like, it is extended like a rubber band. And the further this thing goes from at least some semblance of normal, the harder that thing will snap when it eventually at least has a downtick. Now, that doesn't, I'm not calling or expecting some sort of crash. I don't necessarily think that, again, unless conditions change massively. But I also do not think that this kind of move is going to be super sustainable. That's my baseline. If you take a look at where the close is from the 200-day, 75.6% above a 200-day. For those that don't know, a really interesting way to measure momentum is by measuring the distance off of different kinds of moving averages and longer term moving averages. So that's one of the measurements that I'll use as a general proxy for severity of moves. The summation for that is that's fucking insane for something like this. In vol, literally just doesn't get higher. So one idea though is if you're feeling froggy and you want to trade vol, you can do that. I would be really inclined to try and look across the curve and to figure out where I think the vol is priced the richest relative to its moves. So we can use something like this and we can say across different time frames how much the movement looks like against different durations. So I have to imagine that most of it is going to be pretty pretty fucked. But there will be pockets. So a good example of like those pockets is like here, 180 days out, which is a lot. It also looks like 7 days is coming down a bit. Same thing for 14 days, like that stuff right there in the front. But you're going to be picking up a ton of gamma. So you have to, again, pick your poisons. You can run stuff with like calendars here. I definitely, I mean, the cool part is silver is small enough, the ETF at least is small enough that you don't necessarily have to spread off your risk. But if you're in a smaller account, definitely makes sense to do so. The other thing to remember though is with something like SLV is that it is not a European style option. So what that means is if your shorts end up in the money, there's a good chance that you'll have to or you'll want to at least manage the trade so that you don't get assigned on one of the legs and then have to deal with that. Again, you're still covered. It's not a big deal, but you have, the residual position available to cover it. It can just be more of an annoyance, especially if you hold that kind of thing through expiration. That sometimes can screw people. So yeah, to summarize all of that, I wouldn't be super interested in trading vol right now. When vol is this high, this typically actually is not a great time to trade it. It's going to be closer to fair value. And the realized moves are so high, I would wait until the realized moves start to trickle down to give at least a little bit of an opportunity. But right now, with realized moves expanding this much, even though on 30-day vol there's still risk premium, that doesn't help overcome the trending element of price. So not only are the realized moves coming up, but price is generally trending in one direction, which will still hurt you. Even if the realized moves remain lower than implied, the cascading effect of momentum in one direction will still hurt you. So yeah, SLV has been absolutely nuts. Okay, still paper trading, which is awesome, by the way. What a great name. Says, what about GLSI? Let's take a look. What do we got here? Greenwich Life Sciences. It's been moving up a couple days now. Curious about it. The low volume with fast price up. Yeah, that actually is good eye, by the way, because I completely agree with you. This is, well, okay, a couple things. The volume actually isn't that low when I look at it now more in detail. The reason why I say that is because the volume is much lower than the catalyst, whatever this was on the 15th. There's a catalyst of some sort. We could figure out what that was. I don't know what it was, but it's something. Okay, so there was a drug that showed 80% reduction in breast cancer. Again, notice what I just did there. I don't know this stock. And as soon as I see this, if you rewind and heard what I said, there was a catalyst here. I know that. I don't know what it was, but I know that there was one here. Do I know it with certainty? No, but 98% confidence interval that there was a catalyst here, and there was. Now, this is tied to a breast cancer drug. The thing to keep in mind, though, is that even though this volume is astronomically high and is probably skewing your perception, all of this volume in here is also very high. It's, again, just your perception that's skewed. So, for example, the volume on this day here that I'm hovering on is 585,000 shares, where the 20-day average is 322,000, which takes into account this. So if you go back prior to that, which is going to skew the numbers a lot, the average volume for the day before that for 20 period was 80,000, and the 5-day period is 141,000. And again, going back to this, it's 585. So the volume here is actually extremely high. It's just not as high as this. So I wouldn't, the only thing I would correct there is I wouldn't look at this and say, well, price is going really high on light volume. It's actually going high on really strong volume. Everything just relative. That said, this also tells you that there's a lot of really smart people that know that this new drug has a significant amount of potential, which is leading to this drift. This is a perfect example of information discreteness and indiscreteness. This is information indiscreteness. What happened was a catalyst came out here, a new piece of information, a phase trial release, and effectively they're saying, hey, this drug helps reduce breast cancer, which is fucking awesome. Save the titties. And after that, it has taken several days for interested parties to build position and at least begin to scale in. So if we take a look now, unfortunately, there's no options, which breaks my heart. Options and stuff like this can be super, super interesting. But this is in the middle of a breakout. So these kinds of things can be really lucrative, realistically, if you continue to see this sort of strength. And these are the kind of things, at least for me, I typically run them as very asymmetric profit opportunities. So what I'm looking for is how much momentum this thing is going to get And then I'm looking for when it begins to consolidate, what does the consolidation look like? And then is there another leg up? Now, the options market typically is really, really informative for all of that. But we could see really quick and see if there's, I don't know even if this thing will have them because they don't have options yet. That's a bummer. I wanted to take a look at them because I want to look at their insider transactions and institutional sponsorship. So let's see if we can find any of that. First, we can take a look at insider trading. Small on the 18th. Oh my God, guys. So, I mean, they've been scaling into it, which is good. It doesn't look necessarily as awful because they've been scaling in, but this purchase is a little sus on 1218. When we go to 1218, that's right here. Maybe that's good. Actually, I'll give them more credit than that because it's not before the catalyst. So yeah, they're just betting on their stock. I don't feel as weird about that. That seems okay to me. And again, bummer that there's no options. So I think here the there's a couple ways that I would look to trade something like this. You can either think of it as a pretty high risk entry, and you can look to take an entry as it's in the middle of this pretty strong parabolic up move. Again, one of the key things that I would really want to see is institutional ownership. Let's see if any of these have that, because I would want to track how aggressively institutions are getting in and at what point does it become saturated. So GLSI institutional ownership graph. And looks like Fintel's got us. Oh, this isn't. Okay. I wanted to look for a graph, so we might have to look for one more. Let me see if NASDAQ has it for us. Okay, so this is good. This is good. So from an institutional lens, right? People that have more capital, this is still early days. Early days. Early days. This is cool. The reason why this is cool is because when you look at other companies, let's take a look at like Apple, for example, and you look at their institutional ownership, you see it's like literally 65%. It's massive. But when you look at something like this, that is literally single digits, that is super important because that means that there's a lot of potential upside, a lot of potential upside. And now we can take a look at what the recent changes have been. And let's take a look. So most of them have bought in on this side at least. And then let's take a look. BlackRock trimmed a little bit. Vanguard went up. So there's big names in it too, which is actually really, really important. So yeah, this is a really fun name. Nice job, paper trading. This is a really, really fun one to come across. Again, I'm a little bummed that it doesn't have options, but that part aside, the institutional ownership part is good. How's the short interest? Ooh, that's actually a little long. That's really long. That's really, really long. Yeah, this is a fun follow. The summary for that and the way that I would think about trading it is either higher risk entry with pretty tight stops, and you'd have to size it really carefully because of how high it is on these candles. Don't forget, this is still a cheap stock. It's only 20 bucks. So this day itself is a 20% day. So you have to keep that in mind when you're thinking about building some sort of position. Even if you place a stop somewhere, down here at like the 1625 handle or so, that's still a healthy move from where the stock closed on the day. So that's something that you got to pay attention to. The other thing that I really, really wanted is actually like an institutional ownership graph to see how it's evolving. But wait, here we go. Here we go. Here we go. This thing's giving it to us. Perfect. No, no, I don't want your fucking cookies, dude. So scaling up, down, and it's been up. So this is a good trend. Yeah, this looks interesting to me. This really does look interesting to me. Especially with that recent catalyst, my guess is you'll actually see the institutional ownership continue to expand again, depending on how strong the news is on it, which I am not going to pretend to be an expert on, how strong the drug is and how effective the drug is, but it's very clear that the market likes it for sure. So let's take a look at some of the news around it, and let's see what we can learn about this thing. So heavy, heavy volume. And on Monday, it had a phase 3 trial of Flamingo 01, which is evaluating an immunotherapy to prevent breast cancer recurrences, showing an approximately 80% recurrence rate reduction in 220 patient open labeled non HLA arm of Flamingo 01. This is actually important too because that's not a huge trial. That's a small trial. I'm sorry, it's not a small trial, but it's not a huge trial. The reason why that matters is again, that gives way more upside potential if like scale and scope can be demonstrated. I'm actually really curious if they'll start offering options on this. That would be really, really nice. But yeah, I think that this looks really interesting. And this is clearly institutional sponsorship. It doesn't even take that much to move this. But the total market cap itself is still, I mean, there's only 13 million shares outstanding, so it's a pretty cheap name. But this looks really cool. Let's take a look at a couple scenarios. So a stop below here at like 1625. No, let's take a look at buying shares. So this is looking at 100 shares. Now, the other thing to keep in mind is, again, without options markets, it's even more difficult because there's absolutely no context for any of it, right? In terms of even trying to figure out like what a distribution might look like. So we do see that there absolutely is price activity up here at like the 30.5 handle. That, in my opinion, is actually super important because what that can look like is one of two things. It can look like really, really heavy selling when we get up towards that level as people are really interested in getting out at a scratch or a break even. But the other thing is that it clearly has traded up at these levels before. So I would expect that volume node to serve as general resistance, but this is effectively one of the spots that I would be paying attention to, again, just to have some level of context on where this thing has been before and at what point. So like even this 30 handle, you can see that the bulk of this volume node really starts at like the 35 handle. That's what I'm seeing there. So I would consider that a little bit of ways to run for sure. But the risk in the trade is not insignificant, especially catching something like this that already has had its breakout. The way that I typically trade stuff like this is a little bit different. It would be a little earlier of an entry just to limit total risk. But again, I wasn't looking at it. So yeah, that's a fun one. Good find. Really good find. Juicy, or oh, I'm sorry, July. I'm sorry. July Klim says for parabolic stocks like SLV, could we consider a 6 month slash 1 year long put where vol is lower and gives stock time to move? How could we improve the structure of the trade? Yeah, let's talk about that. It's a great idea and it's a good instinct. So what this person is saying is like, hey, I think that this thing is high. I'm not exactly sure when it's going to come down, but I believe at some point it's going to come down. So what if I put on a trade and give it a bunch of time to potentially work? and then give it, time to work, which isn't a bad idea. Here's the series of issues with that. The first thing is your instinct to go further out in time is smart, but it's also important to pay attention on relative terms. So, first things first, we don't actually know if vol at 6 month or 1 year is actually low. We know that it's lower than the front, but we actually do not know if it's low relative to itself. And I'll show you what I mean. Let's go into here. Let's take a look at SLV and let's take a look at the vol. If I turn this in terms of a percentile and I get rid of the front expirations and I look at the further expirations, so I'm looking at 90 days, 180 days, stuff in there. What I notice is the volatility percentile at those points is literally 100%. So what that means is even though the volatility out there is lower than what you're seeing in the front, it by no means is low relative to that time frame. If you have any questions on that, please ask. I want to make sure that you understand that because that's like a critical piece to understand when you're looking at options. That's the first thing. The second thing is the way that the trade will behave will likely look different than you might expect. So typically speaking, when an underlying goes down, you would expect to see volatility contract. Whereas in something like this, you might actually see, I'm sorry, if something goes down, you typically would expect volatility to expand. Except in something like this, it might actually contract a little bit. So that would very likely fight against you here, especially because you're effectively buying vol when it's the most expensive it's ever been. Well, that's dramatic. The most expensive it's ever been over the last year is the correct way to frame that. The other thing is this, and this is more so the important factor. Let's say that we execute this idea, and let's say that we go out 180 days or 90 days, whatever. What were we saying? 6 months or so? Something like that? Yeah, so we'll do like 120 days, somewhere in here. We'll go to the April, May. It doesn't really matter. And let's say that we buy a put, and let's say because vol is so high, we choose to go deep in the money because we want to decrease how much extrinsic value is in the options to begin with. So let's say we go to like the 100 puts that are at like a 70 delta. And let's eyeball this really quick. Here's what ends up happening with this kind of trade. If you put this on, and again, let's say that the expectation is that the underlying is going to go down, which is fair. The problem that you have here is that if the underlying goes against you to begin with, and then it reverses and eventually starts going down, you might not actually make that much money. Here's what that looks like. If the underlying continues to go up because it's in the middle of a breakout rally to the upside, it just gapped up and then ran like another 20%. It's up huge. Let's say it continues to trickle up. And let's say that it hits like 85. So if it's up here at 85, you're looking at an unrealized loss, which, isn't anything that catastrophic. But then if it does begin to go down, what happened in this scenario is you would have lost deltas. So as the underlying, that helps you, by the way. You losing deltas as the underlying goes up means that the pain slows down. But what it also means is that when it eventually reverses, you're not going to participate as fast. And we can ballpark what our deltas might have become by making a few guesses. We can say, how long do we think that move might take? And that kind of thing, which we'll do right now together. So spot price right now is about 70. So if it goes, 15 points, it's 71. So if it goes 15 points, we would expect to see it at 86. Let's take a quick look. If we start with the 100s and then we simulate that 15-point move-ish, in this case, more like 16 points, that takes us down here. So what that means is your option that you originally bought for 70 deltas now is 57. So then that means in the beginning, If you get a move in your favor, you make 70 cents per dollar move. Now, if you get a dollar move, you're only getting 57 cents. You're effectively getting half of the move. Now, if the underlying does begin to trend in your direction, you will gain your deltas back. But ultimately, what that ends up meaning is you miss on the down move that you think you might get. And this is how it works. Let's say that the underlying continues to trickle up, and then you finally get your down move. And let's say that the down move is pretty good, but unfortunately, let's say that that down move just gets you back to about where you were before it begins grinding up again. So in that kind of scenario, you can see how you find yourself in a tricky spot where you might actually get the move that you want, but because of timing it poorly and overpaying for vol, you might not actually make anything. You might even lose a little bit. That's not to say it's a bad idea, but the more important part is I wouldn't look at going further out in time, 6 months or a year, and say to yourself that removes the burden of timing. You still have to time. Because if you don't time it well, then you're still going to lose money. And again, you're really, really coughing up for vol here. It's the most expensive it's been in the last year. Let me know if you have any follow-ups on that. It's a really good idea in the core concept, and it's a good way to think about options, but it definitely is one of those things that I think catches a lot of options traders, and then you're kind of looking at yourself saying like, what the literal fuck happened here? And obviously, we don't want that. Any questions on any of that? And then is there anything else that you guys want to talk about or take a look at? More than happy to. It's already been dark here. The sun sets at like fucking 3:30, so it's been dark forever. We're just gonna cook some dinner. They have like they have a like wood fire sauna that I gotta go start up. I think which would be pretty fun. But yeah, absolutely happy to take a peek at anything else that you guys want to look at. July says, can you please elaborate on your first point relative vol? Yes, absolutely. I'm glad that you asked. Also, how might you make a play on this? Wait for a breakdown in a higher time frame, market structure? Yeah, okay. Good follow-ups. So here's the first point, reiterated. What you're talking about in terms of the cost of volatility is based on this, right? So when you're saying vol is cheap 6 months out here, vol is objectively cheaper here. It's 62% at the 112 days to expiration, right? So 62% is much cheaper than what it is in the front at like 86, 84, all of this stuff, right? Much, much cheaper. However, volatility is relative to the term that you live in. So what that means is when we're looking across time frames like this, that's using a time series. When we're talking cross-sectional, which is at a point in time, looking at each individual expiration relative to itself, we have to ask ourselves a different question. So the way to summarize that first part, the way that you're looking at this is you're saying based on a time series looking across a term, this vol is cheaper than this vol. That is not incorrect, but that's just the first part of the analysis we have to do. The second part of the analysis is we have to say for this specific expiration, the 112 days to expiration, this specific expiration, how expensive is 62% vol? Even though 62% vol is much cheaper than the front, that doesn't mean that it's cheap relative to this 112-day expiration cycle. So when we do that, and we look at something close to that, right, using like the 90 and the 180 constant maturity to give us an interpolation, we can see that both of those are at 100%. So what that means is the implied volatility for that specific term is literally the highest it's been over the last year. So even though this vol is cheaper, right? Even though the 90-day, the 180-day, in this case, the 112-day, even though this vol is cheaper than the front, it's very expensive relative to itself. That's what that means. And if you have any more follow ups, like if that's not clicking, please tell me. And then we can look at a couple examples and see if that helps drive the point home. But the overview of that is you want to look at vol in those two ways. The first way is you want to look at vol across the term structure relative to other terms. That's the way that you looked at it originally. The second way you need to look at it is within each term. How expensive or how cheap is vol within the individual term at a set point in time? That's the main difference there. And then the second, in terms of how might I make a play on this, I think we talked a little bit about that earlier, but happy to reiterate. The main thing I would look for is this thing to start breaking down. That's it. I don't try to front run it because it's already higher than I would have expected it to be. So what that tells me is I don't know how much higher it could go. I don't necessarily think it's going to go that much higher. And again, this is a good example of being able to use the options markets, right, to figure out what the market is pricing in. So if we take a look at something a little closer in time, let's take a look at like the 19 days. And let's close this up a little bit. We can see how the deltas drop off super fast on this call side for the out of the monies versus the put side. And that's a good way to assume or approximate moneyness. And you can also use probability of touch, probability of in the money. But let's take a quick look. Yeah, so this is within a specific term. And this is looking at, uh-oh, did we just drop? Are we back? Did I lose you guys? Okay, are we back? It looks like it's okay. The cabin that I'm at, they're using Starlink. So it seems like it's been pretty good, but let me know. Okay, cool. Thank you, Reese. Where did we leave off? We were just talking about delta relative to time, yeah? Okay, cool. So let's take a quick look at what delta, how these deltas look for the at the money, and then we'll go out a little bit and then back in. Actually, I'll leave those up for now. And so the at the monies, I'm just going to do the whole strikes. So 72, 71, 73, like that kind of thing. So let's take a quick look. We'll go, how many is this? This is 21. Here. So this is the at the money. What I'm going to do is update this so that it automatically does the math for us, or at least the first part. So the at the money here is going to be the 73s. 73s. And then this should get us down there. Good. And this will equal +1. And that'll get us there. Okay. So now what I'm going to do is just throw in the deltas for a handful of these. We don't have to do all of them. You kind of don't really need this many. We just need to go out like maybe 5. And you'll get the general gist of what's going on. But the slope of the deltas actually tells you a lot of information. So I'm going to move this again off to the side just so that I can go a little quicker. And we're going to start with the out of the monies here. So we'll go to the 74s. which are at 48 delta, then 45 delta here, 42, 39, 37, 34, 32, 0.3, 28, 0.26. Okay, and then we'll go the other way. We'll go to the 72s, which are at a 54 delta technically, because these are literally, this is all, by the way, skew, which is actually really cool, like how much vol skew there is. But anyways, let's take a look at the 72s, which is a 46 delta. Then I see 43 delta. Then I see a 40 delta, 38 delta. Then the 68s, 35 delta, 32 delta, 29, 20s or 0.27, 0.24, and then the 63s, which are 0.22. Okay, so this is within a single series. Actually, what we should do is build this out for two different terms. I won't do that now. I'll do that for another time. But we'll do delta for term 1 and then delta for term 2. But the important part here is you can see how this slope here is steeper than this slope here. What that's intuitively telling you is what the market is expecting to occur going forward with respect to price. And the other thing that's actually kind of quite telling right now is how the 50 delta is way out here at the 73.5, and it's partly because it's literally up again after hours, but it's not quite there yet. So the market is also still expecting some positive drift. This is just a way that you can use the options market to determine like where you think price might go. So if we take a look at the probability of a touch, there's effectively a 51% chance that we touch 81. And then if we take a look on the other side here, and we look at the probability of a touch around 50%, which is here, that's 62.5. So this has a slight probabilistic edge because this is closer, but it's the same 50% probability. This is further. So the market is absolutely expecting a bit of drift continuation. All right. And then for the second part, hold on, you had a clarifying. I meant to say if vol was cheaper, not that it is cheaper. That is more clear. But can you explain how you were able to compare the vol for a specific term? Yeah, so the way that I was able to compare the vol for a specific term is looking at, there's different tools available, but the tool from Unusual Whales is, what the fuck? Oh, it's over here, duh, idiot. The tool from Unusual Whales is really convenient. So what this is doing is giving you a constant maturity interpolated vol. That's all. And then it's plotting what the vol was for that maturity over the last year. And then it's just creating a scale for it. You can do that yourself if you don't have a tool like this. It's a little more annoying to do, but it's definitely doable. So that's that. And if vol was cheaper further out, then you relieve the vol piece, meaning in terms of overpaying for vol, but you do not relieve the timing piece. You still have to time things well. Otherwise, you kind of set yourself up for problems. So that's that. Good questions though. Anything else for you guys? This Greenwich one is super interesting to me. I also have never seen this website. Yeah, so it's still in like the really aggressive growth phase. July says, does bar chart have this? I have no idea. I have absolutely no clue. Let's see. Where would it be? Um, I'm not sure. Let's take a look at SLV because this will at least have options because we're missing a thing here. Let's take a look at vol. So this is just giving us a single term. Let's take a look at the vol charts. That's term structure. This is vol. Oh wait, hold on. Maybe it does have it. Where does this go? Yeah, it does. Literally right here. That's perfect. It sure does. So it's not quite as clean because it would be nice to be able to do this for multiple terms at once. That's typically my preferred. But I'm actually going to reach out to him right now because I have a buddy at Bar Chart that I connect with and make videos with. But I'm gonna shoot him a video. Hold on one second. Quick question. For the volatility charts on the platform, you guys have a great plot of IVP for various terms. A massive improvement for this would be if you are able to plot multiple terms at the same time to compare IVP of the multiple terms. Cool. So I will see if he. I need to take a picture of this though. Fucking take a picture. Ta-da. Yeah, and I'll literally see if their dev team can help us out. Because I legit think that would be super useful. RL says, did we cover Bitcoin? I don't think we talked about cryptocurrency. Let me take a peek there, see what's going on. I do have a covered strangle in IBIT, so that's where I'm going to start. Ah, great. This is actually, I say that partially in jest, but the fact that this is oscillating sideways is actually really good for me because it gives the position a little bit of time. What I don't like is that this oscillation still seems to be more negative leaning than anything, which I don't fully love. That's a lie, because those I'm effectively having to force fit. Yeah. So here, it's definitely in a bit of a descending wedge kind of thing. But the consolidation is good. I don't really like that it's trickling down as much, but I do like that the floor is trickling up. So it kind of has like some competing elements for the way that I look at this stuff. Very mixed. What I'm doing now is I just want to see what the options market looks like. So it does look like it has some pretty massive call skew, but I don't know if that's short calls or long calls. So we can solve for that by taking a look and seeing uh, yeah, by seeing what the yeah, so it looks generally bullish, especially on those calls. So it does look like it's leaning bullish on the call side of the equation. This just looks like standard rolling. Yeah, this is a lot of just general movement. Nothing. Nothing that's sticking out to me there. Take a look here. And I want to look at the premium. Look at like the next, this light is spazzing out behind me. Yeah, so there's definitely a bit of fall skew with respect to premium, especially as you get further out in time. This is clearly a general expectation of upside recovery at some point, which, at least to me, literally just makes sense. It literally just makes sense. What I'm doing now is I'm looking at a couple of these terms relative. I don't really want to be in the front here. I guess we could, I don't want to be there. And I'm just taking a look at the OI. There's just some synthetic longs. And definitely, yeah, more, definitely more long call activity than I would have expected. So yeah, this looks, this looks like the market is, expecting upside. But I feel like the difficult part of that is when the recent consolidation I think is good, but the consolidation, as far as I view this kind of stuff, is more just like a condition that you need before it can start posting a reversal. The competing interests here is the fact that the lows are trickling up like this is good, but what's not good is that the lower high here is trickling down. So I don't love that. It's actually at a spot where I would be really interested to see how it behaves there and then how it behaves there, like here. Those are the spots that I would need to see it break one way or the other. But for the covered strangle, I can tell you what that looks like. What do we got? What do we got? Okay. So for the covered strangle, I'm pretty much out in 16 Jan. And the underlying I'm underwater on, but the option side of the equation is looking pretty good. Actually, I need to take some of these down. I'm glad that we looked at this. Yeah, I got to take some of these down. And I actually might want to grab some more shares as I'm looking at this. Because right now my basis is at 56. I don't know what my utilization is right now, but I'll have to take a look. So yeah, I think cryptocurrency though, especially just Bitcoin in general, the volatility has been pretty nasty, but it really needs to hold I would consider like this consolidation level like pretty bad. Otherwise, if it does, yeah, like if it does continue this downtrend, I think that's pretty nasty. And this here doesn't look great. I would really want to see this low higher, and I would want to see this consolidation at least at level, if not trickling up slightly from here. So if I had to like ballpark in terms of all that, it looks to, at least for me, it looks to favor a little bit more weakness than strength. But we will see. Sweet. All right, gang. Super fun connecting with everybody. Thanks for hanging out and thanks for adjusting with the time a little bit for us. I'm gonna go figure out what this fucking light bulb is doing, and then we're gonna make some dinner. We got some ravioli on the docket, and then tomorrow we're gonna go cruise around Denali, go see what that's all about. As always, if you guys need anything, you can hit me up in the Discord. Be an outlier. See you guys later.